a new client over the weekend, and it's pretty interesting because you go back to basics with them. You kind of start all over and give them your thoughts, and it's really interesting because you build on that and you realize that it's just kind of gels your ideas. So here's a couple things that are really concerning me with the economy today, and it's the bonds and the stock market. Let's just go with the bonds. I think that people do not realize that there's two huge risks in the bond market today that really are not getting enough coverage. Number one is credit default risk, and particularly evident in the high yield. High yield has diverging. If you look at the charts, it's diverging pretty severely from the S&P. And the S&P is off to the races, heading almost in a parabolic up trend, and the credit defaults are have turned down and decoupled from the S&P, and they're trending down. So that's signaling just on the technicians that we have some trouble in the credit markets. But let's just think this through, in that a lot of these high yields were sold by the drillers and the oil producers in the Bakken Reserve. I mean, that was such a wonderful story. It was a boom for people. Fortunes were being made, high wages were being paid, oil was being sold, and now that the oil has tumbled, why, it's put all these companies at risk. Drillers are at risk, the bonds are at risk, and a lot of these bonds were insured, and that insurance is being used to pay the interest on these, but of course that's a finite insurance package, and that will go away. So, and that's probably going to start being evident here within September, October, November, and you'll start seeing some defaults in oil patch. So maybe I'm wrong. Maybe oil will go back up to $60, $70, $80, $90 a barrel, but if it doesn't, we certainly have some risk. A couple other things. I mean, I'm going to pick on Puerto Rico and Chicago. I was born on the south side of Chicago, so I know Chicago pretty well. Chicago has an awful lot of labor unions, and they have an awful lot of government employees and teachers. They've been promised pensions, and I don't know that the city really has funded them well enough. And taxes are going up. They're driving some businesses out. And Chicago just got downgraded on their ratings to junk, or just a little bit above junk. So now if you own those Board of Education bonds and they got downgraded, you lost money. Now they're being downgraded for a reason. The reason is that they're subject to credit risk. They may get defaulted on because there may just not be enough money. I mean, Mayor Rahm is quoted saying he wants to raise property taxes 25 to 30%. That's a lot of money. Chicago's already got one of the highest tax rates in the nation. They're going to raise it up another 25-30%, and now they're talking that they're going to start taxing people who watch TV on the internet. They're going to start taxing not YouTube, but a lot of our content. So they need money. So that puts us all at risk. So if you have bonds at risk with the city of Chicago, and if there's a default, you certainly get hurt. Now, the other one I'm concerned about would be Puerto Rico. Puerto Rico has said, we're not going to pay our bills. We don't have the money to pay the bills. So they have a new governor. Governor said, look, I have a choice to make. Either I can punish my citizenry or I cannot pay the bills. And, of course, there's a few hedge funds that are really squawking because they own a lot of Puerto Rican bonds. And the governor said, no, I'm not going to pay. So he's been petitioning Congress to default, to bankrupt Puerto Rico, which would be a little tough for any bondholder in Puerto Rico. So, and I think that this is just the tip of the iceberg. I pick on Puerto Rico and Chicago, but Illinois is no poster child, and California, I think, is in deep trouble. And you have sovereign risk across the globe. You have, we've been talking about Greece, but Greece, you've got Ukraine, and Belarus, you've got Belize, you've got Costa Rica. There's just an enormous amount of people. Now, let's keep this in mind that an awful lot of these third world bonds were delineated in U.S. dollars. So now, that was great when the U.S. dollar was softening up, but now that the U.S. dollar is getting stronger, that means that if it goes up 20%, that means your debt goes up 20%. these countries that are commodity producers, and as China quits ordering all this enormous amount of natural resources, their economies soften, and now with the dollar strengthening, it puts it at credit risk, that of default. Now, we were here in the debacle. I mean, Phoenix is a poster child for this. This was just awful, is that we just got decimated here with our real estate holdings because we had such a huge bubble. But people, when we originally started short selling homes, people were underwater. They needed to sell their house. And to be short sold was a terrible stigma. People would say, "Oh, I just can't do that. Ethically, I can't do it. Morally, I can't do that. I don't want my credit impacted." But once your neighbor starts doing it, your best friends, your brother, the people down the street, people at work, all of a sudden that stigma goes away, and everybody starts short selling. Now, it turned out to be a good thing, and probably it would be for if we had a defaults across the world. But I'm thinking that's probably what's going to happen, because we're getting to the point where they just cannot pay the bills. You borrow, the countries and municipalities and states, they're no different than you and I. They only have so much money coming in. If you borrow more money than what you have money coming in, you can't pay, and that's where it's at. Now, couple it if we have any kind of hiccup in the world economy, say business drops 5 or 10%, and you're working at break even. Now you're no longer working at break even, so you have credit risk in a lot of bonds. So my advice to you is to review the bonds. Now, not only do you have credit risk, but you have interest rate risk. The Federal Reserve has made no bones about the fact that they are going to raise interest rates. They keep saying that. Now, they can always back off and say, "Oh, the economy, is too slow. We don't want to do that." And I'm sure, look at the IMF is telling them not to do that, and a lot of world banks around the world are telling them not to do that because it'll just make the dollar that much stronger. But if they do raise interest rates, they'll raise it on the short end. So everybody who is conservative and into the short end, you're going to get hurt on the short end. But what happens if interest rates on the long end went up just 1% or 1.5% or 2%? Could they do that? Absolutely. They could go up 5%. But let's say they just went up 1.5% or 2%. You went from a 3.5% 30-year fixed rate bond with the government to 5%. Oh my Lord, your bond portfolio would be decimated. So not only do you have credit default, you now have interest rate default. So I don't know that a lot of people really understand the risk of the bond market. And here again, once interest rates start going up, and here would be a nightmare scenario for me. As the U.S. dollar strengthens, as I told you before, a lot of bonds around the world are denominated in dollars. So if the dollar goes up, when we start raising interest rates and the dollar goes up, that means if you borrowed 100 U.S. dollars, now you have to pay back 120 or 130 or 140. And if the economies are slowing, you can't do that, so you default. And I'm afraid that once the default, people start running to the U.S. dollar, you start strengthening it even more. So it's just going to start waterfalling upon itself. So I think there's a lot of risk in bonds. I think there's a lot of risk in stocks, but that's for another day. So what I'm advocating is that you go into your portfolio, look at your bond portfolio, just look at your bond portfolio, and take a significant portion off the market. Now, I think that there's going to be a scenario of this, is that we have a slowdown, you have a certain amount of deflation, and then we have inflation in the outlying years. We're in the real estate business here in Phoenix, and I'm going to unabashedly tell you that we're one of the best markets in the world, bar none. We get cash flow on our properties, we get growth on our properties. We're going to have our population is going to go up 25% in the next 5 to 10 years. We're going to add another 1 million people here. That's going to need all kinds of infrastructure and businesses and growth. So we're in a growth market. We're expecting our properties to appreciate. But first, I think we go down. We are really income investors, so we want to buy a property and keep it forever. I had a client last Friday was telling me that his family owns Centennial Farms. A Centennial Farms means it's been in the family for over 100 years. They'll never sell the farm. Never. It doesn't matter if it's worth $5,000 an acre or $50,000 an acre. It will never get sold. So take that out of your mindset. We're income investors. As they are, they'll say, well, should we plant wheat? Should Should we plant corn? Should we plant soybeans? What's going to give us the greatest income? That's what we are. We're income investors. So here in Phoenix, I'd like you to take a portion of your money off the bond market. Let's reinvest it here in Phoenix. It's a great asset preservation for you. Particularly if you're overseas, and I have overseas clients. If you're in Brazil or Argentina or China or anywhere in Europe, if the U.S. dollar is really appreciating, and it is in a bull market, and there's a lot of indications that it is, it's going to be higher this year than next year, or next year is going to be higher than this year, and the year after that. That means you're going to get a currency play. So not only do you get here in one of the most stable countries in the world, into Phoenix and Scottsdale, one of the most stable markets in the world, and a growing market, you get to bring your wealth here. It's a great asset preservation to bring it here. Now, we can also get income off that. So not only do you get wealth preservation and U.S. dollar preservation, but you also get an income. And we were absolutely the poster child for one of the worst real estate crashes in history. Was right here in Phoenix. We were at the epicenter. But now I must tell you that although the prices in real estate crashed, rents did not. So at the very worst, it went down 10 to 15%. We were impacted by our cash flow. But let me just say that our management fees went down. Our vacancy factor dropped like a rock. Our insurance costs went down, and our taxes went down, which all mitigated the dropping of the rent revenues. So we really mitigated. Our net really was affected, but all things considered, not too terribly much. So you can bring your money here. We have very safe, stable markets. It's a safe environment for people to bring their assets here. We have, this is sunny Scottsdale. This is the playground of the rich. We have golf. I think we have 185 golf courses here in Scottsdale. It is just It is sunny 330 days out of the year. It is stunningly beautiful. We have golf everywhere. We have football teams, baseball teams, basketball teams. We have every entertainment imaginable, and it's right here in Scottsdale. It's one of the best places in the world to live. And you can bring your money here, and it would be a good place to have it. So once again, let me just review this, is that there's a lot of risk in the marketplace. Tremendous amount of risk in the bond market. So review with your financial planner. He's welcome to call me. We can put our heads together and see what's going to work best for you. And you can either get into our portfolio, you can manage it yourself, you can have us manage it for you, but we'll certainly lease. And if I am wrong and everything just goes fine, what you'll have is a really good piece of property here in one of the growth markets of the world, and it'll be leased, and you'll be getting a cash flow on that. If I'm right, what I expect to see is a little bit of a dip, and I think it'll be a real problem for the stock and bond markets. But in the real estate, we'll have a little dip, and I think it's nothing more than a correction within an ongoing bull market. And personally, I think we have the greatest bull market in history. It's certainly in my lifetime, coming very shortly, and a lot of it's going to happen right here in Phoenix. So I am really, really excited about that. We have a little bit of problems beforehand, but I think in 3 to 5 years, things are just going to be going crazy here. We're just going to be doing really, really well. So give me a call if you have any thoughts. I'm certainly here available to you, and I wish you the very best. See you later now. Bye-bye.